Welcome to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And this week, we're continuing our conversation about where to keep your money.
The value of the wealth that you're building is more than just what's on hand.
You might have some cash value life insurance and some real estate and some retirement accounts, but who's connecting the dots? Hey everyone, welcome back to the podcast. So last week we were talking about credit cards and rethinking your emergency fund and how your line of credit can actually and should be considered part of your emergency fund. We challenge this idea of needing to keep so much money sitting in cash for emergencies or for just in case. We believe strongly that your money should be working hard for you. So that poses the question, okay, I have this money sitting here. What should I do with it? So this week we are going to hear from Bob on what are the best vehicles to put your money in. So Bob, tell us what you think.
Great. Thanks, Aaron. Good to see you guys again this week. So, first of all, start off with, we're not giving financial advice, right? This is just for educational purposes only. We don't know your situation just yet. Hopefully we do sometime soon. But please take this as just thoughtful advice and information. So got that disclaimer out of the way. And so, yeah, this is a hot topic. And when I say a hot topic is because there's opinions everywhere. They fly everywhere. And it depends on what camp you're in. And when I say what camp you're in is really what your background is and what experience you hear that fills that brain of yours to make that opinion of that you have. So there's a whole camp that's, the Dave Ramsey camp, which we've talked about before, is it's great advice. It's great information from a very basic core level, but that's for the general public. And then we have certain advice that is for the top 1%ers, the wealthy, which is you, Doc. I mean, your income is top 1%. You are the wealthy. Now, you may not feel that way, right? You may be sitting there going, my goodness, I make a lot of money to the point we just brought up, but I just don't feel like I have a lot. Well, great. That's the whole issue. Well, that is not great. But the point being made is that that's the issue, though. Where are the best places to put your money? You filled your brain with growing up as an adolescent, growing up as a teenager, growing up in your early 20s, going into college, medical school, residency, and now you're making money. And you were filling your mind with different things and opinions that was being absorbed. Those usually aren't you. Okay? Now, also, this conversation is specifically to you, Doc, as a general conversation of all wealthy physicians, which is you. Okay, I think I've pounded that point a little enough, right? So we call these the 3Ds. And I've written these in both my Economic Termites book and my Farming Assets book. And the 3Ds are really the most tax efficient assets. So before we dive into those, let's talk about taxes. And that's really the important thing is that, and why a lot of our physicians don't feel like they have enough money is because that big expense, the tax bill, and depending on where they're at in the country, at minimum, at maximum, it's going to be 37% federally. Most of our physicians are in the 32% to 37% on the marginal tax bracket. And then depending on your state. So if you're unfortunately in California from a tax perspective, weather perspective, hey, great, good for you. But on the tax perspective, you're going to pay that weather tax. And it could be with the Fed, it could bump you up over 50%. So that's a significant amount of money. So, the first 6 months of the year, you're paying governments. The second 6 months, you're finally paying yourself. So yeah, Bob, I don't feel like I have enough money, right? So when we look at this perspective, the 3Ds are really designed to talk about these tax efficient assets, okay? And these assets that the IRS gives you and I to be able to build our wealth. Okay. And so generally the 3Ds are deductions. What assets give us the most deductions? Well, businesses. Now, don't get me wrong. I'm not saying quit your job at the hospital and go start a practice. We're not saying that at all. There's always a purpose, and business is different. Just drive to the hospital and move your head back and forth and look at all the businesses on the road. They're all different, right? But the point is they all get deductions, and the government, and there's a specific reason why we have this. We won't talk about it here, but how that's structured and the methodology of how the government treats that. Depreciation. So real estate provides the best, greatest depreciation. Now, it also allows you to accelerate. And at the time of this recording, in our tax code, we also have bonus depreciation, which is the acceleration of other physical assets like equipment, that you can accelerate that deduction or that depreciation like you can with real estate. Okay. And then, of course, you have oil and gas. Okay. And those are the three main assets. And I use those interchangeably because I used to just talk about real estate. And then I realized, you know what, that's not really fair, because we do have this bonus depreciation. We do have this oil and gas environment. And there's a lot of great tax benefits. And for the right person, they're equally important. So that's depreciation. That's the second D. The third D is distribution. The whole point of having an asset is to create distributions or income. Now, here's the catch. Income is taxable. Cash flow is plannable. So that is the tagline, our bumper sticker, so to speak, that we talk to our members about is, if you're going to create income, that's going to be taxable. That's how the tax code's written. But if you're going to have cash flow, then you can plan that cash flow to create distributions. And that's why we use the word distributions, is because depending on the asset depends on how it's going to be taxed. But the most efficient one is cash value life insurance, permanent life insurance. Now, used as an asset. Remember, I said the most tax efficient assets. Okay. So creating these three environments to basically figure eight through them, utilizing all three of these particular 3Ds allows you to accept the opportunity of what I call the asset buddy system. You get your assets working together in an overall plan to help build your wealth. Okay, so let's talk about that. Did any of those, did I say savings or checking account? Don't think so. Did any of those, did I say a brokerage account or stocks, bonds, mutual funds, ETFs? I don't think so. Did any of those, did I say any of the other assets that we may have heard about, that crypto, right? That's not tax efficient either. Now, it has its place. All of those things have their place, but if we're looking at the pyramid of, or the foundation of building a house, right? A pyramid, the largest part, land mass or space, is the base. Same thing with the house and a foundation. It has to be the strongest. It has to be the strongest. Now, every environment. So for example, I'm in Texas, and we have different soil here in Texas than we did in California. Our soil here actually doesn't settle as well as California's soil. So we actually, when we build houses, our foundation has to be built differently. And we have to have a water system that keeps the ground moist year round to not allow the ground to shift too much to create cracks in the foundation and in the house. Okay. The reason why I bring this up is that what we're talking about is areas that we put our money in. We got to start from the foundation first, work our way up. And this is why everyone talks about emergency money. Why I brought up cash, checking account, brokerage account. That is typically where most of our doctors, we see their money for emergency. But it's not very efficient. And the reason being is that if it's in the equities market, you are taking risk. So you understand that, or hopefully you understand that you have that risk on those emergency funds. You have your savings or checking account. You have risks there called inflation, right? In the last 5 years, we saw a significant amount of inflation. So that money was devaluing. Now, you may still have had your $400,000 sitting in the savings account earning 2%, but it was being devalued as in the cost of life continued to go up, right? So it's deteriorating. That's why we call taxes and inflation as part of our economic termites. Okay. So this is why last week, we talked about credit cards and line of credits being your emergency fund, because you don't have emergencies every week. You don't have emergencies every month. A lot of you don't have emergencies every year. So why are we taking that emergency fund advice as let's deteriorate our wealth? Okay. That does not make sense, though that's the advice we all hear. And it's because most of the professional advisors do not look at all other aspects of business and assets of how to accumulate wealth in what we call the asset buddy system, in those 3Ds we talked about. So one of the foundationals is, okay, we have our lines of credit as emergency fund, check. Now what, Bob? Well, you should have money sitting in your checking account to pay your bills, right? We're not saying don't put any money there. You should probably have some money in the savings account for that upcoming trip, or, or we have some members that like, 60,000 just feels like the number I need to have in my savings and checking account. That's what makes me feel well and sleep well at night. Awesome. Leave 60,000 there. Again, we're not saying this that you have to have a zero, right? We're saying that, okay, you feel well, you feel healthy, you're sleeping your 8-9 hours a night now. Great. Everything above and beyond that, we need to put in other assets. So what's the next foundational aspect? In my opinion, again, this is not investment advice, is you should utilize that asset of cash value life insurance. Because of the distribution, it's tax-free. You have access to it. You can utilize it, and you can also utilize it when you're going to buy real estate or anything else. You have access to that equity. So if you're going to be a real estate investor and you're going to use banks, well, interest rates are kind of high right now. Doesn't it make sense to not use a lot of the bank's money and use some of yours and blend that to reduce the expense of the investment so you cash flow more? Kind of makes sense, right? When you're buying real estate with the bank's money, they're charging you, and it's going back to them. You don't have control over that. You have control over your bank, your family bank, which would be cash value life insurance, to determine how do we use that. Right. And we talk about how to structure this with our members, how to be able to use these other assets, not using cash value life insurance to go buy your family vehicle, like a lot of insurance agents talk about in this bank on yourself or this family bank. Okay. Well, yeah, just go buy a car and don't pay a finance company, pay yourself. Well, you're buying a brand new car that depreciates right off the lot immediately. If you're looking at any YouTube guys that talk about pickup trucks right now, a lot of these SUVs and pickup trucks have lost 30% of their value, 40% of their value, and they're still sitting on the lot. They haven't been driven off, and they're already losing their value because of the economic situation. So where does that make sense? That's not an asset. You just turned your asset into a liability if you're using that cash value life insurance asset to buy a vehicle. That makes zero sense. We're focusing on the interest paying back to yourself, but you just literally tripped over $1 million bag to pick up $10 on the other side. Makes zero sense. Now, if you utilize that asset, your cash value life insurance, to buy real estate, that's a no-brainer, because now it's another asset. It may not be cash flowing right now, but you have control over how you manage that cash. And this is something we talk about. How do we do it? What tools do we use in the tax code and accounting and legal system to be able to structure all this stuff? We do that with our members. Okay. So that's one. We have a lot of members that, quite honestly, that based on their religious beliefs, they don't do debt. They don't do loans. Well, cash value life insurance, it's your money. You're not using a bank. It's your money. So it allows you to leverage within your religious rights to still be able to buy real estate, not all cash, but create a relationship between this asset and you asset, this cash value life, in being your own bank. Okay. So it creates a lot of solutions for certain situations. That now, is it the only thing? No. This is a asset in an asset buddy. You have to have more than one system that utilizes each other. So that's one thought. And so I'm going to pause right now and because I did a lot of talking, I'm going to take a breath and see if there's any questions or thoughts or comments that you guys have that we can add to this.
I think one of the questions that's going to come up is, let's say we follow this plan. So I'm gonna take your opinion, Bob, not advice. I'm gonna take your opinion, and I'm gonna say I don't need to have all this money in cash for emergencies because I've yet to experience an emergency. So I've analyzed and said I don't need to have that much there. I'm going to use it. I'm going to use credit cards as my emergency fund. Where do those assets go then that are still liquid enough, because let's say I do have an emergency and I don't want to have it necessarily an income generating, because a lot of our doctors, they don't need more income. They do want to build wealth. They don't need more income right now.
Exactly.
And so that's one of the issues, at least that I've seen with our members, is they have this realization, I've been chasing, these investments that have a high ROI when I didn't need ROI, I needed wealth building. So that's a big shift. But I do need to have I need to have some assets to cover that chance that there is an emergency. I use the credit card. I've got 30 days plus, to pay it off. So where do I put that money that's still somewhat liquid, but is following the 3Ds input that you're giving here?
Yeah, so that's a great response of really how we can utilize cash value life insurance, the same asset, because you can control the access to that. And so when, let's say we had an emergency, we used our credit cards, okay, and we paid for that emergency, and you get 30 days or before your cycle's done before interest starts getting charged, right? Assuming you don't have an introductory rate. Right? Imagine, this emergency is coming up and you get an introductory rate, or you call your existing credit card and say, hey, do you guys have any introductory rates? And they say, yeah. Okay. Can we work on getting that? Right? They want it. If you're asking, they know you're going to spend money. They want a balance on that credit card, right? Because they're going to know, based on statistics, you're going to forget it's there and eventually you're going to pay interest. Well, we're not going to forget, but they don't need to know that, right? They're going on their statistics. So let's say it's a $30,000 event, whatever that is. Doesn't matter. Well, it does matter because it's an emergency, but $30,000. Well, your cash value life insurance, you have the ability to have access to those funds within 7 days. There's not a huge underwriting process like with banks, where they're looking at your debt to income ratio, you're submitting your tax returns, your pay stubs, they're looking at your retina and they're running your blood, right? They're doing all these things to try to say, yes, you're worthy, right? Now, as a physician, your process in getting money from banks is a little bit different than the rank and file people, the rest, because financial institutions understand how you as a physician make money. So a lot of times your underwriting process is actually less, right? But that's not what we're talking about. When you're utilizing cash value life insurance and you have access and you borrow funds from yourself, from your asset cash value life policy, you get those funds in 7 days. But here's the thing, you get to control that as well. So if you do have an introductory rate on that credit card, does it need to be paid off right away? No. So let's let your cash continue to compound, earn interest, and grow until it needs to be paid off. Then you get that loan. You've earned your interest. You've made your money, a little bit extra. It's a dripping faucet. Every little bit over a month, over a year, over a decade, over a lifetime creates wealth. So why wouldn't we use that compounding to your benefit? Now, let's say there is interest on it. Well, great. What I just say, you get access to this funds in 7 days, you pay it off, or you pay a portion of it off and you extend the other part to the next month so that you still have some cash earning based on the interest rate. Point is, to your question, Joe, the point is you are in control. You're in control. And you're making money on your money versus if you just had the money in cash or checking account, you paid for that emergency, you've lost control. That emergency is now taking control over you in your life, and you have no ability to earn money on that money any longer because you used cash. Okay. Now, my opinion, what we say is not a dictation to our members. We don't say this our way or the highway. No, our job is to exactly why we do this content on these YouTubes. It's content. It's information. It's your money. You decide what you want to do. We're just giving you options that most people don't know actually exist. And we know that because this is the feedback we get. Oh, I didn't know that. Okay. Did that answer that question, Joe? Great.
Absolutely.
Aaron?
No, I get it. And I see a lot of our members have cash value, and the more sophisticated ones have used it. And so when we're doing their asset map, they'll show you, oh, we use some of that for this. And I know what you've shown us about how you can borrow, but then it still keeps accruing. It's like, and I think what you just said is like, people don't know what they don't know. And unless they are some of the more sophisticated people in this area who've done a ton of research and learning themselves, most people don't know these things. So you talk about the buddy system. After cash value life insurance, what's the next piece of it?
Yeah. So then it becomes about, okay, to Joe's point, well, when do you need this money, right? Is this to help build your wealth? So I think there needs to be a more clear understanding of what wealth building and accumulation means. Income is not that, right? What's our bumper sticker? Income is taxable. So going out and investing in real estate, like all the real estate gurus say is, get cash flow, right? Positive cash flow. Well, that's taxable income on your tax return, right? So there's an issue there. Now you do have depreciation. So second D, right? Depreciation in real estate. So you can accelerate that depreciation depending on the type of real estate to offset your income. Sure. But when you utilize the acceleration of depreciation, then you don't get it for future years. So what happens to your cash flow? Now it becomes taxable. So it's a Band-Aid, but it's a tool. And what do you do with tools? You use a tool when you need the tool, right? So if we're building a house, I'm going to use a saw when I need to cut something. Well, more specifically, wood. Right? And then I'm going to use a hammer or a drill to do something with that piece of wood of where I'm going to do it. I'm using different tools for a different purpose at each time I need it. Okay. So what you need to understand is that if the tax codes build for businesses, we need to understand you as a business. And so we need to build the value of you. That's not necessarily a bank account statement number or a investment number, or even a rate of return number on your investment statement. That's what we're all focused on as the individual. But as a business, we're focused on value. Let me give you an example. What's one of the most valuable companies in the world? Apple. They're close to $2 to $3 trillion is their valuation. Does that mean that's what they have as revenue? No. Is that what they have as cash in the bank? No. What is the value? It's based on their ability to build a business, how they make revenue, goodwill, tangible, intangibles. And the marketplace values that business at $2 to $3 trillion. So if someone wants to buy Apple, they got to write a check for $2 to $3 trillion. So we need to build your value because, to Joe's point, we don't really need all that money right now, right? I need the money for down the road and access the distributions down the road, the income down the road. So not all of your money sitting in savings, checking, or brokerage account should be in quick liquidity. So having buckets of liquidity is important. Within 12 months, important liquidity. 12 months to 3 years, 36 months. That's an important bucket, right? 3 years to maybe 5 or 7 years. And then 10 years and longer, right? These are buckets where we need liquidity, and building a plan should allow you to help your assets, your money grow, and be in tax efficient assets where you're not having to pay taxes every year on the value or the growth of that particular asset. Deferring that income to increase the value, That's extremely important. Another great example would be Amazon. I think a few of our members have heard of Amazon, right? Small little internet company, right? They're also one of the most valuable companies. But you realize when they became a public company, meaning that, hey, public, we want you to be able to buy shares and own part of our company. Okay. The scrutiny that they have to go through in their financials and the underwriting and all this fun stuff to become a public company for your safety as an investor. I kind of say safety tongue in cheek because you still lose money owning Amazon, even though they're profitable, but another episode. So when they went public for the first 2 decades, they showed a loss as a public company. Did that mean the value of the company went down? No, it kept growing up because they would take their profit, defer it instead of taking it as income and giving it to investors as dividends or interest. What they started doing is taking that and putting it back into the business to grow the business. And what happened to the business? Now is one of the most valuable companies in the world. So the business of you, we need to understand how to use these tools, assets, using the legal system that lays it out for you. Just follow that rule book and the value of you goes up. But you also need in your plan to understand, when are we extracting distributions or money, or when are we creating liquidity events, meaning the events where we have access to that capital. It may become income and it's taxed, but you've planned for it. So you know when it's going to happen. Versus right now, most of our members are reactive instead of being proactive.
Well,
And
I
a lot
think
of
part
the
of
advice
the
is reactive.
I think part of the issue that a lot of our doctors are experiencing, and the reason why they're, I'll call it, overly invested in cash positions, is because they don't really understand their own personal cash flow. A lot of these doctors, and Doc, we love you, but some of your spending is absolutely out of control. And so part of the reason why you have so much cash and you're worried about emergencies, not really emergencies, it's what you qualify as an emergency, which is just a purchase.
Mhm.
And Bob, I think to your point, having a plan for those things can be very helpful. Again, we're not going to tell doctors what to do with their money. We're going to give them advice when they're a member of ours on how to navigate through life so that they can add value over time. And I think that's a really well-made point, Bob, is like the value of a company is not just the assets on hand and the cash on hand. It's the goodwill. It's all of it. Same with you, Doc. Like the value of the wealth that you're building is more than just what's on hand.
Yeah.
And I think getting some of those things under control, talking about their personal cash flow, that's going to dictate their income needs. And everything beyond that really should be inside of a plan. And most of the doctors that I think we've brought on as members come to us, and part of the reason why they're so grateful for the work that we're doing is it just feels like for the first time, they actually have a plan. And they can feel comfortable saying, oh, I don't need all this money sitting right here. There's a plan for when something comes up. So I think a lot of it is just a little bit of self-reflection and understanding what your needs are and where you want to go. And when you have that vision, it's very compelling.
I think a lot of professionals, when they get an expertise in a particular area and they have a client that comes to them, they take the approach, I'm going to tell you what to do. Our approach is telling you how to do. There's a big difference. What to do is not necessarily the right thing for you as an individual, but how to do can be, because it's your situation. And so when we are being told what to do, we feel like there's an urgency or there's a necessity that makes us say, okay, I'm not going to go find rest of information or ask more questions. I'm just going to do what they said to do. But how to do makes a world of difference. It's like that old saying, it's you can give somebody a fish or you can teach them how to fish.
Right.
Okay. But teaching how to fish isn't the easiest thing. Same thing. How to do it takes time. It takes a process. And so that's the importance. A lot of professionals don't have time for that process, which is why they tell you what to do, because they have food they have to put on their table as well. right? And it's just a different approach and dynamics of how to understand that aspect. And so we've built a model to where it gives us the ability to say how to, which is why we start with saying we don't give financial advice. We don't. We give the how-tos, and you ask questions and we tell you how to. It's pretty basic. And so anyway, so those are some thoughts that of what people can do. I mean, there's obviously more assets out there, and I think that's getting a little more into the weeds in certain scenarios and situations, which would almost be, hey, let's look at certain case studies, right? What did we do for this type of doc in this type of situation, or vice versa?
Yeah, that would be great. So like you said, our purpose here is to share information and knowledge and just make our listeners aware of what's out there, how the wealthy are doing these things. And I think you provide a lot of value, Bob, but there's always more questions that are created. And that's kind of the point. Joe likes to say, hit the easy button. We know not everyone can hit the easy button, but a lot can. You, like you said, you don't have the time to be doing this all yourself. You might have some cash value life insurance and some real estate and some, retirement accounts, but who's connecting the dots? How do they all fit together? How do you use them to lower taxes and build that future? That's really what we're here for. So, Doc, if you have more questions and want to know how to put it all together, let's have a conversation. We would love to talk to you. Book your cash flow recovery conversation with us. Follow along and invite your friends. We love sharing this with you. So thanks for being here. And until next time, go be a Wealth Maverick.